What's up, everybody? I am back with another edition of the Sunday Scaries Stock Talk podcast. But before we get started, I want to give a special shout out to our sponsor, Financial Stock Data at financialstockdata.com. You can find them there and get a full month free of their premium service by using the promo code GCI, like Green Candle Investments. They've got a lot of great things that you can use to analyze all kinds of stocks, almost every single company, and look at all the different valuations and metrics. A lot of great stuff in there. They also have a watch list and some other cool features. I actually had Steve on the podcast last week. So if you want to hear about those features more in detail, be sure to tune that in. But this week, I've got a very special guest, Lenardo at Invest Quotes. Lenardo, how are you doing today?
Good, good. It's actually Leandro. It's kind
Leon?
of a
Oh,
yeah, but it's
my
kind of
bad.
a strange name.
Yeah, my bad, my bad. So we got kind of introduced first through the stock market game, and yeah, you had a great pitch. I believe you made it to the finals. Is that correct?
Yep. Yeah, I
Yes.
think that when you were there, I pitched Adian. I think
Yeah,
so.
yeah, you did. So yeah, it was a great pitch and a lot of insight there. So I wanted to get you on, but first, why don't you tell us a little bit about yourself and like how did you kind of get started into investing?
Okay, so I studied economics in university, and I started reading. Well, I had several investing courses, nothing too serious, to be honest. And I started reading on my own about investing, about Warren Buffett, Peter Lynch. Like I don't probably like 90% of the people start going into investing, and then I started investing in index funds. But then I kept reading about investing. I actually had the feeling that the more I read about investing, the more difficult it seemed. So the more safer I was on index funds. But then I also started to read about market sentiment and how the market can go to both extremes, both to euphoria and to panic. And I thought that I actually liked like analyzing individual companies, so I decided to start investing in individual companies. I also have still my index funds because I know that like I run a diversified portfolio, and a large part of it is just index funds that are obviously very diversified. And that's how I started, and that's why I do it now full time, because I actually love analyzing individual companies.
So that's awesome. So it seems like you kind of have always been interested in, investing or maybe something along those lines by, studying economics. So is there something that you think that you could kind of point back to, like, growing up? Is there like, maybe your parents are investors or like have some sort of investments or something along those lines that kind of triggered you, or were you just always kind of interested in the concept of money? Like what kind of got you to the point where you're like, okay, this investing thing seems pretty cool. I want to start looking into it.
No, it was kind of on my own because my parents are doctors, and in Spain it's not so common to see people investing in stocks. Stocks here have a very bad reputation with everything that happened in during the global financial crisis. I actually think that the Spanish index without dividends reinvested is actually lower than in the year 2008 still. So people just see stocks like a way of losing money, not fighting in inflation. So I started on my own because I was curious outside of my of the several topics I had in university about investing, but nothing around me like pointed to investing, neither my friends or my family.
Yeah, so it seems like just kind of like self, fulfilling, I guess, which is pretty cool. So you mentioned it, before, but when you first started investing, you started reading into like Warren Buffett and some of these other big time investors, which seems kind of common because Warren Buffett, he might be the most famous just straight investor of all time globally. And obviously very well known and everything like that. So, do you take anything that you've learned from him? Maybe would you consider yourself like a value investor or something along those lines? What did you do to kind of start researching? Did you just see his strategies, or did you just kind of, I guess, look at his mindset?
Well, I from Warren Buffett, I think what I take is his mindset, because I don't consider myself a value investor. Well, I think that everyone, if you do investing correctly, you should be a value investor, so to say, because you are technically buying something that's worth more for a lower price. Um, but I think it's his mindset and his ability to focus on the company and on the stock price. I think that when you buy a company because you have done all your research and you think that the company is reasonably valued, uh, focusing on the stock price is not really worth it, because the stock price will move wherever, but the company is still executing as independently from the stock price. Well, there are obviously some exceptions. For example, if you have stock-based compensation or whatever, that kind of your expenses can be tied to the stock price. But that is what I think I got from him, and also from investors such as Peter Lynch, that follow more or less like the same mindset of not focusing on the stock price and focusing on the company. And that's actually what I think gives investors a very good edge over others, because I think 90% of the stock market is focusing on daily price moves, and actually very few, less than people think, I think, really buy a company with a more than 3 year investment horizon.
Yeah, exactly. So I agree with you on like all those principles too, because I don't know if I'd really consider myself a value investor either, but yeah, I agree that I think everybody at the end of the day is looking for undervalued companies, right? So I mean, if you buy a company and a stock, you would assume that you would think that it would go up, right? That's why you're buying it. And so, yeah, I mean, the general basis around value investing, I think, is just kind of present in um, every single investor's mindset. The difference is, I think, that they focus a lot on the fundamentals and the pricing of the stock. But there's been like this tech boom and everything like that, where it's if you follow the normal Warren Buffett method, everything has been, I guess, extremely overpriced, and some might say that it's still even overpriced after this 20 or so percent correction. So like I guess how do you you were kind of saying that you look at like the underlying business. Like, do you analyze any of the financials or anything like that when you're looking at companies? Do you kind of I guess use any of these value investing principles or metrics, kind of like price to earnings ratio or anything like that?
The first thing I do when I start to analyze a company is, I think this very few investors actually do it. I ran a poll on Twitter some weeks ago, and the results were a bit worrying, so to say. Like, I read the 10K because it's basically the probably a document that you have all the relevant information. Like, if you want to know what the business does, they basically tell you what they do. I don't think you'll find a better place to understand what they do than the management telling you what they actually do. And also, it's sort of unbiased information, because it's regulatory filling, and they cannot obviously be too positive on what they think. So that's the first thing I do, and I obviously look at the financials, because I think there's two parts to an investment. One is the numbers, and the other one is the story. Obviously, the story of the company ends up being reflected on the financials. So I think you need to look at the financials, then look at the story, and try to guess where the financials might move if the story is executed correctly. So that's sort of what I try to do. Obviously, it's not easy because the numbers are obviously objective. You see what the numbers are, and there's no like you cannot make an opinion on that. It's what it is. But investing is all about the future, so you need to understand the story very well to try to predict where those numbers are going to move.
Yeah, I agree with you 100% there. So, that's very interesting, and I read the 10Ks as well. But I also I like how they highlight the risk sections in there, right? Because I think everybody kind of discredits that risk portion in a 10K, where sometimes when you look at a stock, people just really see like the bull arguments and don't really focus on, what potentially could go wrong or, what could change maybe your thesis. So when you're like looking at a company, do you like actively try to poke holes in your thesis? And if so, like, how do you kind of go about that?
Yes, I do. I also read obviously, I read the whole 10K. So I also read the risk section. The problem about that section is that it's actually pretty boring because there are risks that are so obvious. They have to put them there, but they are pretty obvious. Like, I don't know, if we stop selling, our revenues will be impacted. Well, yeah, that's obvious. Like, if you don't achieve more customers, your revenue is going to be impacted. But every once in a while in a 10K, you can find on the risk section something that you would have overlooked just by reading information outside of the 10K. So I think it's really important to go over all of that. And then I also try to read as many bear articles as I can find on the company. uh, I will actually think of some of them. I would think that the bear case is very weak, but obviously others you get important risks that maybe you had not considered. And I actually do that twice. The first thing that I do is read the risks and the bear when I know what the company does. Obviously, when I already know what the company does, I read the risks and then I continue um, analyzing the company because I think it helps me be less biased, like positively biased. Once I know the risks, I know that I'm not going to read something of the bull case and magnify it because I'm going to know that there are risks behind that. And then I read it just before starting the position. I read them again just to see if I have missed something.
I gotcha. So, are there any, I guess, specific sources that you use to find some of these like bear arguments that you kind of like ascribe by that you think, these people when breaking down a stock generally give good bear arguments, or are you just kind of, I guess, more so crowdsource it on Google or something along those lines?
I do it on Google.
Yeah.
Actually, if you write sell and the ticker or something like that, you actually get access to a lot of of their articles.
Yeah, that's not surprising at all. So, yeah, there's always somebody with some headline, right, where it's like no matter what company, it's like either buy or sell right away.
Yep.
So, yeah, pretty interesting stuff. So, I want to get into, I guess, a little bit about you being in Spain. So, I know that it's investing in at least the United States has become like very popularized and is all over the media, and everybody's kind of talking about inflation. But you mentioned earlier in this conversation that stocks have a pretty negative connotation in Spain, with everything going on with like inflation. I know it's drastically affecting me in the United States, and I know it's probably affecting you over in Spain as well. Has that perception sort of changed? Do you think that conversation is kind of shifting where more people are getting involved in investing?
Well, I think that's a great question. I think um, it's kind of strange because it's difficult to explain to someone that they need to invest to beat inflation because normally in the years where you have high inflation, investments are not doing very good. So it's not very intuitive, but I think you need to try to make people understand that investing is a hedge against inflation, but not specifically during the year where you have high inflation, because it lets you build your wealth. So when you get to that year, your purchasing power actually has gone up. Maybe that year you suffer a drawdown in the market, because the market always suffers a drawdown when interest rates go up, and normally if you have high inflation, interest rates will go up. So I think it's not changing here, the the connotation about stocks. We actually got here, crypto was pretty popularized here, Bitcoin and everything, but stocks aren't. I think one of the reasons is that um, the Spanish stock market is not really performing well, and the stock market is only in the news when it's actually crashing. So then it's very difficult for someone to have a positive opinion on stocks when the only place where he or she sees the stock market is when it's crashing 30% or so. So that has not changed. I imagine that we could do a better, like a better task of educating people, for example, at university, on personal finance. Here there's no like personal finance education. Nobody invests for their retirement. Well, maybe some people do, but it's not the norm. People typically live here paycheck to paycheck, and what they save, they leave it in the bank, and they have the cash, and that's it. Um, Inflation here is a problem. I think much like it's a much more dangerous problem than in the US. Actually, inflation in Spain has just reaccelerated this month, so it went down to 8.2%, and now it's at 8.7. And the worst thing is that in the US, you actually got some wage inflation, so to say, that counteracts it more or less. In Spain, the wages are not going up like since 5 years ago. So people are actually seeing how their purchasing power is going down dramatically.
Now, so because their purchasing power is going down, I guess how is that kind of changing the everyday person? Like I know in the United States, we got a lot of people jumping from job to job. They called it the Great Resignation, where a lot of people went from one job to a new job because the new job usually you can kind of you have like a couple years experience, you could kind of make a jump to the next level and usually get a pretty big pay raise because they're always looking for good people. So that's kind of been a trend in the United States where a lot of people are kind of like jumping from job to job, seeking that higher pay. How are people in Spain kind of battling it now? I mean, you mentioned crypto and Bitcoin earlier. Are more people, I guess, trying to use that as savings technology, or are people kind of doing the same trend in the United States as like jumping from job to job?
Well, I think here there's a problem with people starting to invest, because a lot of them got interested on investing since the pandemic, and then they saw the huge run, and now they're seeing a huge drawdown. So that's not the best scenario for people to actually trust the stock market. So I think people are just here. We also have the behavior of people jumping from job to job. But I do see, and I find this kind of worrying, that people, I don't know if this is specific to Spain, are demanding like better working conditions, like working less, or being more flexible, and at the same time earning more. So like making more from the job. So I think that's going to have a large impact on productivity if it continues to be like that. I was, before leaving my job to dedicate full time to investing, I was a consultant. And when I started, I knew that in being a consultant, I was going to work more hours than my contract said. Like it was like an unwritten clause in the contract. But now I actually see people going into consultancy firms and demanding like very good, I don't know how to say it, like good conditions on their job. And I think it's obviously fair, but you cannot pretend to work less and make much more than someone who was working much more than you made. So there's people jumping from job to job, but I think the overall market is stalling. It's not easy to jump from one job to another one and get a raise in that process here in Spain.
Yeah, so it definitely is happening here in the United States too, where a lot of people are trying to fight for that, work life balance, where they want to work less, get paid more, maybe work from home. I work from home at my new job that I started almost like half a year ago at this point, but um, yeah, so I mean, it's definitely, I think, a global issue, and it's like productivity is definitely not being helped, from there. So it'll be interesting to see kind of how this all plays out. I know that there's a lot of speculation of potential more money printing or everything like that in the United States, which could affect the markets overall. But anyway, so when you look at companies, and you kind of like have this overarching view of what's going on right now, um not necessarily like taking a dive into like the macro environment or anything, but do you like kind of look at companies based on maybe the country that they're based in, or do you primarily invest in like United States based companies, or I think it's always kind of interesting to talk to European investors to see like, whether or not they're investing strictly in their home country, or kind of how that process works.
I typically invest in companies in the US, but this doesn't mean that they only operate in the US. Like most of them have international revenue. So I think that where a company is listed, it says little about uh, like the international presence of that company. So that's one thing. And then about macro, I think there's a big difference between knowing that macro impacts company fundamentals. This is actually pretty straightforward. Like if we have a recession, then companies that are making money from the economy, like from the rise of the economy, are going to be impacted. But there's a huge difference between that and investing based on macro. I don't invest based on macro for several reasons. First, I think it's hard to predict because you don't have to predict only, like, for example, now, do I have to predict if there's a recession? Well, that's one part, but then you have to predict how severe it will be, how the government and the Federal Reserve will react, and then also markets are second order like tools. So you not only have to predict the recession, you have to try to guess how the market will react to the recession. So I think it's quite impossible for me to guess all those things. So I try to look for companies that are resilient, so that are not going to get wiped out in that recession, and also that they are established and have good competitive positions, because they actually, like, recessions actually help these companies. Like, think of all the big tech companies. If we have a recession now, digital ads can be cyclical, e-commerce can be cyclical, whatever, but they're actually going to come out stronger because all their competitors are probably in a much tougher position than them. So I would make that distinction because macro is important, obviously, but I don't think that investing based on macro will make you a lot of money over the long run. I think it also depends on your investment horizon, obviously. Like, if you invest for the next year, then macro has like a very large importance in your investment process, because you can actually suffer a 30, 40, or 50% drawdown like we had in 2008. I think it was 55% or so. But if you invest in like 5 or 10 year horizon, then you're going to go through several cycles. You will go down with a downturn, and then when the economy recovers, because I don't know, we have a long history of countries recovering from recessions, um, then you'll take advantage of that. So that's how I view it. Although I have companies that have exposure to Europe, and I think the situation in Europe is much worse than in the US from a recession standpoint, because we had much more dependency on on Russia, especially for energy, and I think we are being impacted quite a bit.
Yeah, no, I gotcha, and that all makes sense, and I agree with you. I think to invest based on macro is kind of ignoring the underlying fundamentals of a company, and kind of at the end of the day, you're investing in a business, right? But I think like macro is something to be aware of, because I think like in certain environments, right, there's going to be some sectors that it doesn't matter what you buy, that it or like all tech, for example, at the beginning of COVID kind of went up, right? And there was like a few that went up more than others, and some boomed. And right now, like energy and oil stocks are doing really well because like you said, like the kind of the dependency of energy and oil companies in Europe that have made these companies make more profit than normal, just strictly because they need to ship out the oil and kind of exit that dependency from Russia. And yeah, I mean, I just think like there's certain factors too that like can affect a company that maybe necessarily isn't based on their underlying fundamentals. But if you have a long enough time horizon, those underlying fundamentals of the company will prevail and make that company more valuable. So when you're kind of looking at or looking for companies, how do you I guess find companies at all to even like start to even like read a 10K? Do you first start in sectors and then go deep into companies that you think, or do you just kind of like, I don't know, find ideas crowdsourcing through like social media or something along those lines?
Well, I think it's probably a mix of everything. For example, I'll get when I started researching ASML in the semiconductor industry. To understand ASML, you have to go, so to say, through the rabbit hole, and then you start seeing other companies. And I've also looked at the EDA companies such as Cadence and Synopsys, and I wouldn't have gotten to those companies if it wasn't for ASML. So I think that when I start researching a company in any industry, you sort of have to understand the industry well, so then you're aware of most of the companies that you see there. I don't say, okay, I want exposure to this industry, and then I start researching the individual companies. I think it's the other way around, that I see a high quality company through social media or doing some filters. Like I think that excellent past performers are a good starting point to find future good performers. There's a kind of a mantra like that past performance doesn't it's not indicative of future performance, and I agree. Obviously, the past does not portray the future to perfection, but if a high quality company has been a high quality company from like for 10 years, probably the probabilities of it remaining a high quality company are much higher than a bad company that you are like wishing for a turnaround now. Like turnarounds are very good because you can profit a lot, but I don't think that there's a high probability of enjoying a turnaround, especially in such high competitive markets. Because if a company has performed really well during 10 years, that's probably because there's a competitive advantage that nobody is being able to match, because if not, it wouldn't have performed that well. And if a company is not performing well during those 10 years, well, probably maybe the industry is not worth it, or maybe there are too many competitors that are eating into their pie. So that's actually how I do it. I think it's more from an individual company to the industry rather than the other way around. I think there are also exceptions because, for example, the semiconductor industry, I think it will be a very important industry in the future. So I wanted to have exposure to that, and then I started reading a lot about the semiconductor industry, made kind of like an industry map, and then from there I started looking at those players that I thought were more interesting.
I gotcha, and yeah, that makes sense. So, we both we'll take a dive into the semiconductor industry in a second, but we're both on that platform called Common Stock, and I've mentioned that platform quite a bit on this podcast because I think a lot of my guests I've met them through there. But I think one interesting aspect of that is that you can share your portfolio and kind of like upload what your holdings are, and people can see when you're writing about these holdings, like whether or not you hold them or not. And so do you kind of use that where you look at maybe some other people that you follow? Do you like look at their portfolios and get kind of ideas from there, or is it just more so I guess like from Twitter, or seeing names, or seeing somebody put out content based on some company?
I also look at that. I personally can't share my portfolio because it's European, and because I have it on the Giro, that it's a Dutch broker, and the best anchor stock portfolio is the private marketplace that I run. Obviously, I cannot share it for obvious reasons. So I will look at that because I think common stock is a great place, especially during a downturn, because everyone gets so negative, and you can see how people are panicking on Twitter, and actually people on common stock, you can see how they are focusing on what I believe is important. So I think it's quite aligned with what I like, how I view investing. And in and through common stock, you can read the some people's opinions, and if you feel that they are very aligned with what you do, it's great being able to look at the portfolio, because maybe if you know that these people are looking for the same things that you tend to look when analyzing a company, well, their portfolio is basically like a watch list, because you know that they have looked for those common characteristics that you also look for.
Yeah, I agree, and I think like yeah, they're very positive too, and I think like kind of like the long form, and to see like whether or not you're the long form of being able to write out your thesis and kind of go into it deep that way, as well as like seeing, like you said, like all right, well, if you have a stock on their watch list, you could see what this person's saying about that stock, and other things like that. So I think it's a great tool, and I think like putting the face to the name, and kind of seeing the breakdown, and not having that limited, the limited character amount. Although, like maybe you could do a Twitter thread or something, but I think on common stock, it's more, yeah, like you said, aligned just for strictly investors, and I think
Yeah.
that tool is going to be very valuable here in the future. I don't personally have my portfolio connected, but I think I do have the ability because I'm in the United States. But yeah, I mean, I think that's coming soon, I would assume, but I don't know for sure. But I think, yeah, overall, great platform, and a lot of people on there as well. So if you're from Common Stock, go ahead and follow Leandro here, and he posts some great stuff on there as well. But I want to dive into the semiconductor industry. So you kind of said it at the beginning that you've looked at this industry a little bit different than maybe you look at other companies. And you think that industry in specific is going to be very important. Why do you think that the semiconductor industry is going to be kind of important going forward?
Well, I think you only have to look at the trends. Everyone uses more technology each day, and it's not only that the people from developed countries have more devices connected to the internet, or more technological devices. For example, 10 years ago, I had a mobile phone, and now I have a mobile phone, an iPad, and a Mac. So that's three. I also think there's a huge opportunity for technology to penetrate emerging markets. For example, if you go to certain parts of Asia or South America, and obviously Africa, um, the tech penetration there is much lower, and it's gonna get there because it eventually, like, it's better for the development of these economies. So I think technology is going to be huge in the future. well, it's already huge now, but I think there's still a lot of runway for it to continue to penetrate different countries. And semiconductors, it's like I don't know how to say, it's like the building blocks of technology. So if you really want to take advantage of technology as a whole without needing to decide what if it's going to be AR, VR, or artificial intelligence or whatever, you know that there's going to be a semiconductor chip behind that. So I think it's a great place. I think many semiconductor companies are diversified already just because they are in the semiconductor industry.
I agree, and we kind of talked offline before we got on here about two of your holdings, so I want to kind of take a dive into some of those. And obviously, this isn't financial advice or anything like that. So before we get into that, but you mentioned two of them. One is ASML Holdings, and I think you've already kind of mentioned that previously, and the other is TXN, which I believe is the Taiwan Semiconductors.
No, it's Texas Instruments.
Oh, Texas Instruments. Yeah, that's right. So let's get into ASML. Why do you like ASML, and what kind of caught your eye about this company that made you want to invest in it?
Okay, so for the people that don't know, ASML basically is an equipment manufacturer. So they build the systems, the lithography systems that later foundries such as TSMC, Intel, or Samsung buy to manufacture the chips. I think they have like they've been, if I'm not mistaken, they were founded in 1984. It was like a spin-off between ASMI, that was ASM International, I think, and Philips, and it was like incorporated in the Netherlands. And since that moment they started betting like very like huge on lithography. Um, Back in the day, nobody knew if lithography was going to be like the best method to print the patterns on the wafers, but they bet huge for it. So they have like almost 4 decades of research and development in that area, and they actually got it right because lithography is now what the most used technology to print the chip patterns on the wafers. And they basically have two types of machines. One is deep ultraviolet, that I think that one goes to the, if I'm not mistaken, 7 or 5 nanometer node. So it's pretty small for a feature in a semiconductor chip. And they have some competition there with Nikon and Canon, but it's basically they have like an 80% market share. And then they have the EUV systems, that is extreme ultraviolet. Those machines are able to print patterns that go below the 5 nanometer node. I think they go up to the 3 nanometer node. So if you want to make the most advanced chips, then you have to use EUV. That's what, for example, Apple's M1 chip, it's manufactured by TSMC using EUV technology by ASML, and nobody is even close to getting sort of a machine that is able to do that. And ASML is already working on the next one. So I think that the moat is huge. Obviously, pricing power is. You could argue that pricing power is infinite because if you want that machine, then you only have one player to go to. The same way that there are not many customers who buy those machines, so that's somewhat a risk for ASML because they have a substantial customer concentration risk. I think 60% of their revenue comes from 3 customers. They don't say which customers they are, but probably TSMC, Intel, and Samsung. And I think they have a very wide moat. The most interesting thing about ASML is that even though they manufacture systems, like to give a bit of context, these systems cost around 150 million euros. each. So there are huge machines that they have to like they send to Taiwan in parts in airplanes specifically to send the machine. And the best thing is that the business is capex light. Well, not very capex light, but I think the capex over revenue from the last years have been around 9%. And that's only possible because the capex is borne by the suppliers of ASML. So ASML has hundreds of suppliers, and then they basically they design the system and they put all the pieces together. But all the pieces, all the research and development for the pieces are borne by the suppliers. So it's a I think it's a rare combination, finding a company that actually does physical goods and so advanced and seeing such low capex.
Yeah, that's awesome. And you made a lot of great points, and it seems like they have like a pretty good moat and everything like that. So there's a lot of positives I can see from this business. But as we kind of stated earlier, you look at like the bear cases. So what are some of the bear cases that are for ASML, and like how would you, I guess, poke some holes in them while you're going through them?
Yeah, so I would say that the main bear case is one that can't be predicted, and it's the geopolitical tensions. Most of the like 30% of I think 30% of ASML's revenue comes from Taiwan. We don't know what will happen there, but ASML is already forbidden of exporting the EUV systems to China because the US obviously doesn't want China to have the most advanced technology. So if something were to happen in Taiwan, if China were to take over or whatever, then ASML's exports of EUV systems will basically be banned to those countries, and that would be a huge short-term shock. But on the other hand, due to the geopolitical tensions, a lot of governments are trying to make like invest in in-house production, like domestic production of semiconductor chips, and that would be obviously a tailwind for ASML because now TSMC is opening a fab in Arizona, and obviously that fab is going to be full of ASML systems, and ASML is going to benefit if Intel goes to Europe and if TSMC goes to the US. I think India is also planning to make significant investments, although I think it's on the design side more than on the domestic manufacturing. The other risks I think are now there's a lot of talk about double ordering in the semiconductor industry because there's like the shortage during COVID has been so strong that a lot of foundries are supposedly asking for more systems like to meet their future capacity. ASML has a huge backlog, and there's some people are worried that if the semiconductor shortage stops and we have a semiconductor cycle, then a lot of these orders of systems are going to be canceled. I think that's a risk for the DUV side of the business, for the deep ultraviolet, but I don't think it's a risk at all for the extreme ultraviolet because I don't think Intel, Samsung, or TSMC would like to cancel an order for that they made 1 year ago and they still don't have the system. First, because they prepay for these systems. So ASML has such a pricing power, and because they're the only one, that they get prepayments, but it's not from the price. Basically, they get payments made by the customers to secure the demand of to secure the supply of the systems. So I don't think that a customer that has already paid will say, no, I don't want it anymore. And then you go back to the end of the queue while your competitors are getting stronger. It was actually one of the problems that Intel had, that they didn't compete with TSMC in the high end chips, and that's why the first system of the next generation is going to Intel because Intel has paid a substantial amount of money they didn't disclose it, to secure the supply. So they know that to remain competitive, they need this system, and if they cancel an order, they are risking remaining uncompetitive for the next year or year and a half. That's another risk. And then actually, there's the obvious risk that all semiconductor company has. That is, what happens if we have a cycle. And I liked how the ASML CEO laid it out in the recent shareholder meeting, when he got asked exactly this question, like, what would happen to the company if now we have a downturn in the semiconductor industry? And he said that they are building the company on a 10-year view. So if there are cycles, well, there will be cycles. There's nothing they can do, but they don't make their capacity planning thinking that there will be a cycle in the next year, or maybe that there will be a cycle in the next 3 years. They don't care. They expand capacity because they think that in 10 years they're going to need it for sure. So that's why they do things. And I would say that those are the main risks of the company.
Yeah, I mean, I think those are all great, and I think your explanation of them are great, and some of them too are, like you said, like out of the company's control. And I think it's like it's pretty interesting that it's not just like the semiconductor industry; it's like a step back of like manufacturing semiconductors. So that's definitely one that piques my interest, and it might be something that I look into too. So I appreciate the breakdown. I think you broke that stock down very eloquently. Now let's get into the next one that we discussed, was the Texas Instruments, ticker TXN. So what caught your eye about this company, and what do you like about it?
Well, Texas, the the EUV systems that we talked about in ASML, those are used primarily to make digital chips, because digital chips follow Moore's law. So they typically need, it's not a physical law, it's just like an unwritten rule that the whole semiconductor industry tries to comply with. Moore's law states that every 2 years, the number of transistors that fit in a chip has to double, while the price has to be cut in half. Up to now, with thanks to companies, well, thanks to the industry as a whole, but EUV has been very important in being able to comply with Moore's law, because it has made the ability to put like make smaller features, so you can fit more transistors in every chip. But then there are another kind of chip that actually, when you like listen to the name, you'd think that it's a less advanced digital chip, but it's like they're not related at all. And it's the analog chips. So analog chips can read, so to say, a continuous variable. So for example, the tire pressure in a car, you need an analog chip to read that, to make that reading, because a digital chip works in binary, so you can only say or 1 or 0. So it's impossible to measure a tire pressure with ones or zeros. So they are used mostly for sensors. Yeah, it's mostly sensors, and for communicating like the real world, transforming it into technology. So for example, we following the example of the tire pressure, if you have a flat tire, then the pressure will go down, obviously. The analog chip will read that pressure, and then will translate that into a signal that a digital chip can read. And that's when the digital chip will tell you in your screen, hey, your tire pressure is low. So they are more like, instead of they are more complements than substitutes. And Texas Instruments is basically the leading manufacturer of analog chips. The good thing about analog chips, and here I go back to the to capex, is that if you look at TSMC's capex spending, it's around 20 or 20 something percent of revenue, because they need always to have the latest system to make the most advanced chips. That's basically how they compete favorably against competitors. But in the analog industry, analog chips don't follow Moore's law. So then you can have a machine that was manufactured 40 years ago that is still working and you're still building chips on it. So capex is much lower. I think the last 3 years, Texas Instruments has averaged capex around 8 or 9%, which is very, very low if you compare it to a manufacturer of digital chips. And they have very, very good management that has been able to put some very strong competitive advantages. So that's what I like. And obviously, with the Internet of Things, autonomous driving, artificial intelligence, those are huge tailwinds for analog chips because all of them are like a source of communication with the real world. And the only way that you're going to achieve that is with analog chips. So that's why I found it. It's actually going out a bit from, I think ASML gives a good exposure to digital chips. And I think I also wanted to have exposure to analog chips.
Yeah, that's great. So, so I mean, it seems like they're both like kind of in the same sector, but they do very different things, which is interesting. So you're not kind of like pointing to, necessarily, I guess, like one. You're getting two different aspects of the sector and trying to get those two, I guess, big players in there. And one, ASML seems like the only player in the manufacturing business. So that it seems like both like awesome plays to me. But what are some of the negative and bear arguments of TXMC? Because I know you said that they're kind of like the big players of, are not TXMC. I'm sorry, TXN. What are some of the negatives as far as that one goes?
Okay, so I think one of the bear arguments is actually I think there's a bit of key man risk because Rick Templeton has been um, its CEO since 2004. He's already, I think, 65 or so. He actually hasn't served as CEO like on a continuous basis because he left in 2018. But his successor, had a scandal that technically violated the company policies, and then Templeton actually came back to lead the company again. I think he has been really, really important in what Texas Instruments is today, especially because Texas Instruments has changed business lines like 6 times. Like they do analog now, but they have during their path. It's I don't know. I think it's close to being a 100-year company, but they have changed like several times their business lines to adapt to the trends that they were seeing. I think that management is really important there because they have to be actually the ones to see where the future, like predicting the future or more or less trying to guess it to change what the company is doing or it's not doing. I think I don't expect a change in business line for the next 15 years at least, but I think it's great having a management team that is able to pivot when something's not going well, and they have demonstrated to do it. And they are also great capital allocators because, for example, Texas Instruments is the typical company that only buybacks stock when the price is low. So throughout 2020, they purchased a bit during COVID, but in 2021 they obviously didn't purchase anything because the stock ran up a lot. I think that's one of the risks. There's also here the risk of competition is also kind of higher than in ASML's case because they do have competitors. Their main competitor is Analog Devices that has just merged with Maxim Integrated. So now Texas Instruments had a market share of 20% of the industry, and analog devices had around 8%, but after the merger with Maxim Integrated, that's going to go up to 13% or so. So um, competitors are getting closer, but it's true that the only way that they have to get closer is through acquisition, like inorganically, and I think that is eroding their competitive advantages with respect to Texas Instruments. And I would actually say that they are going to go into a huge with respect to what they were used to, in a huge capex spending, because they think that they have to expand capacity quite substantially to meet the demand for the next 10 years. So it's also a bit of a risk, because they are going to do a lot of, like, they're going to invest a lot more, and maybe if that capacity doesn't come, then obviously the income statement and the balance sheet is going to be impaired.
Yeah, I mean, I agree with you there. So that's this is some pretty good risk, and I really like the way you break it down. So looking at the positives and kind of understanding the full business, kind of takes understanding, the full product as well, right? So yeah, like good on you for breaking those down, and I think like kind of diving into the mindset of investors, like how they look at companies, is really interesting. And I think the way that you broke down, not only the company, maybe some personnel factors on the last one, but you also look at, the, the positives of the product and the underlying business, which is awesome. With that, we'll ask you a couple final questions, and then we'll get into one question that I crowdsourced from Twitter to close it out. But so the two questions that I've been asking every guest is, right now with in a very inflationary time, like how would you kind of convince or try to tell your friends or family that maybe you should start looking into investing? Would you like even recommend that right now, or would you just kind of I guess like leave that conversation for another time?
Well, I think it's a good time to start looking at investing if you are not. I think it's very easy to convince someone plotting some numbers. You can, like, your time to make income is actually limited. If you work in a 9 to 5, you cannot work 24 hours a day to double your income. That's obviously impossible. So you have to kind of find a way to grow your income that doesn't require of all of your time, especially under an inflationary environment. So, for example, if I get a friend and he's making exactly the same that last year, or maybe he got a raise, but a 5% raise that doesn't offset inflation, then I would ask him to look at what he saved last year in that same month and what he saved this year, just to see, like, he would be, you can quickly see how your purchasing power is going, like it's eroding, because you are buying the same goods but it's costing a lot more. And I think that would be easy um like, it would be easy to convince someone using that. I think the largest hurdle would be to the negative connotation of stocks in Spain. I don't think I would be able to actually um, convince someone using a Spanish index. Maybe I have to use the S&P 500 or the Nasdaq, because if not, they're going to be afraid that they're going to lose even more purchasing power.
Yeah, that's great. That's great stuff. And I agree with you there. I think like just really just diving into the numbers just to show like, hey, like, you're losing all this purchasing power, and that at the end of the day is what money is. So yeah, okay. So then you kind of convince them, like, you show them the reason why, and how to some of the benefits of investing. And then how would you, I guess, suggest for them to get started? Would you tell them right away to maybe pick individual stocks, or would you kind of suggest something similar to what you did and just go straight into ETFs?
No, I would say directly go to index funds, especially because I know uh, a lot of my friends or family have 9 5s, and it's pretty difficult to research individual companies if you have like a full-time job. Like, you can do it obviously, but You have to build the knowledge, and I think that takes a lot of time. So I would definitely recommend starting with index funds, and maybe just stick to index funds, especially because it's very difficult to build a conviction on a company, and individual stocks are a lot more volatile than index funds. So I think there are two parts to investing. If you invest in individual stocks, one is investing in the right companies, and the second part is actually holding them while they execute and they compound capital for you. And I think volatility makes the second part very difficult if you are emotional, because it can actually lead you to sell a company that is actually posting 20% returns on capital with your money. So I think an index fund makes number two very easy, like the second part of holding for many years. I actually never, since I've been investing in index funds, I never felt the need, like, I don't know how to explain it, but I never suffered volatility really. Like, even if it was 20% down the index, I never thought that it would not go, that it would not be better. I think there's upside in the individual stocks with respect to an index, but if you can't handle volatility, or you don't think that you are going to be able to build your conviction, then indexes are the way to go.
Yeah, I agree with you there. I think like just researching into companies is very big, and like trying to figuring that out, helps your conviction. But yeah, if you don't really have an opinion on a company, then it's tough to weather some of those storms of like some of that volatility and things like that too. So I normally recommend that too, and I even recommend to people some of these robo investing apps too. I don't know if they're common in
Mm-hmm.
Spain, but just to get started, that it does something for you and you don't even have to even really think about it. And some people enjoy that, and then some people it kind of starts them going, and then like you and I just start to dive into individual companies and move it a little bit farther in advanced. But
Yeah,
uh,
I think that the most important thing for individual investors is to realize that their edge is not informational. You're not going to have more information than a hedge fund that manages 10 billion. And it's also not one of skill. You don't have to think that you are the most intelligent person in the market, because maybe even if you are, because that's not realistic to think. I think the edge is more emotional and on a time horizon, because professional investors have to prove every year that they were able to outperform. Individual investors don't need to prove that, and that's a huge advantage, because you can actually not act based on price, while many professional managers are forced to act based on price if they want to keep the assets under management where they are. So I think the professional managers' incentives are not aligned with long-term investing, and there's an opportunity there for the individual investor to take advantage of.
Yeah, I agree too. So, yeah, I think everybody has the capability to kind of learn some of this stuff by themselves and kind of figure it out too. And however much you want to dive into it, whether it's like individual companies or just index funds, I think, at the end of the day, you can definitely do it on your own if you'd like. It's just the willingness to do it too. So, yeah, so I teased it right before we kind of got into these last two questions, but we did get one crowdsourced question. It was from Paul, who's been on the podcast before, and Connor at Investment Talk, Paul Sierra, and Connor, who's at Investment Talk, asked for your favorite Spanish recipe. And we kind of went back and forth, and I thought like maybe it's paella, but it doesn't seem like it's that. So, what is your favorite Spanish recipe, and kind of describe it for us?
So it's actually rice with seafood. This can sound as paella, but it's not paella. So in Spain, there's like a huge debate. I don't know. There was a chef from the UK. I don't remember right now his name. That he like went on a program and said, "Look, I'm doing a paella," and he put like lots of stuff in there in that rice. and everyone in Spain like went crazy, like, no, that's not a paella. But you can call it how you want, but it's not. So there's like a misunderstanding in Spain because everything that is rice with something is called paella because it's done on a recipe that is called paella. But the truth is that the true paella that is made in Valencia has like a maximum of 10 ingredients, and you cannot go out of those ingredients. So that's why I say that it's rice with seafood. I could call it like a seafood paella, but it actually, if someone Spanish sees this, maybe they'll go crazy. So that, you know, when you come to Spain and you see like in Madrid that they are trying to sell you a paella, you can tell the guy that that's not a paella. Probably he won't understand and he'll sell you the same dish. But yeah, I would say it's rice with seafood, and I actually have no clue of how to do a good one. So I have to go to restaurants to eat that.
That's hilarious. But it's yeah, it seems like that's kind of a heated and debated topic is like what is actually a paella, which is awesome. But yeah, I mean in the United States, I had no idea. And it seems like, like you said in Madrid, it might be more of like a touristy thing. Is that kind of right? Like maybe you go to the bigger cities, you'll get paella that's not necessarily
Yeah.
paella.
Yeah, like if you go to Madrid, if you have rice with whatever things that they have, but it's not a paella, they'll say it's a paella because all the tourists are going to understand what they like, what they are ordering. If you go, like I'm from originally from Murcia, that it's just below Valencia in the Mediterranean. If you go to this part of Spain, you'll never see the name paella. You'll see like rice with this, rice with this. They'll be made on a paella, but it's not the ingredients. So there's a huge difference there.
I gotcha. That's awesome. So yeah, I guess when you go to Madrid or some of these other big cities, do you avoid a paella at all cost because of that,
Yeah,
or yeah,
yeah, and I tend to actually in Madrid, I tend to avoid every restaurant that have a photo of the dish in the menu because I think like probably the photo looks 20 times better than what they are going to serve you, and even the photo doesn't look good. So I would recommend if you're coming to Spain, to ask someone that is Spanish for recommendation from restaurants, because actually the difference, for example, I live in Madrid. I'm originally from the Mediterranean, but I live in Madrid. The difference between going to a restaurant like that is not for tourists and going for one that is for tourists is huge, both in quality and price. Like the tourist restaurant is going to be much more expensive and the quality is going to be much lower. So I would recommend asking before going into those restaurants.
yeah, for sure, yeah. So I mean, I guess if I ever venture out to Spain, I'll be sure to hit you up and ask for some restaurant recommendations because I feel the same way too. Like here in the United States, right, and like some of the big cities, uh, you'll definitely get the tourist trap kind of restaurants that aren't necessarily as good as like maybe some of the smaller local places too. So I think
Yeah,
it's
I think a good way to identify those restaurants, if it's someone is outside trying to lure you in, like to like asking you, do you want to have dinner? Then that's always a bad sign because that they are searching for tourists probably.
Yeah, exactly. And that's kind of like a European thing, it seems like. I don't know if that's like super common in the United States. At least I haven't seen it too often. But like when I went to Greece and we would walk like in Santorini, walk from our hotel to the beach. There's always people outside searching, and those are the ones that were never very good. And then we were staying at a small like kind of mom and pop hotel, and the guy like drove us to one restaurant that he said the locals eat at, and it's the best meal I've ever had. So yeah, I kind of agree with that point too. All right. Well, thank you so much for your time. I really appreciate it. Why don't you tell everybody like kind of what you got going on and where they can find you?
Okay, so I'm the like leading contributor to Best Anchor Stocks. That is a Seeking Alpha marketplace. We basically try to search for companies that are already established and that have still long runways ahead of them, and by like because they are established, they suffer somewhat reduced volatility with respect to other companies. So that the name best anchor stocks comes from the fact that they help anchor your portfolio without giving up too much returns. So yeah, and they can find me also on Twitter, hashtag like at investquotes, and the same at in common stock.
Perfect. Well, everybody go check him out on Twitter, Common Stock, and Seeking Alpha as well. So thank you so much for your time, and look forward to keep interacting with you, and maybe we'll have you back on down the road too.
Thank you for having me.
All right, have a good one.